and still your host Nicholas. And we are currently on the chapter 3 of Getting Started in Technical Analysis. We have been driving around in a roller coaster of chapters, and we have started with types of charts, different candlestick patterns, and today we are looking at purposefully trading ranges and also different chart patterns. These are very essential in building what we want on the trading charts. So without much being said, we need to understand how the market works and how it flows with what we do. So here we have different support and resistance channels, different chart patterns for us to better understand how the market works, how to navigate through, how to make money through it, and all of that. So let's get on the riding seat. Let's have some fun today. Let's learn a lot and let's apply whatever we will learn today into what we're going to be trading on the charts, into our trading strategies. Make sure you understand everything we are going to be explaining today and apply it to your trading life. So let's go next page. Yeah, trading ranges. Now we have what we call support and resistance. In a narrow market, said by Edwin Leary, when prices are not getting anywhere to speak of but move in a narrow range, there is no sense in trying to anticipate what the next big movement is going to be, either be it up or down, right? But there is someone out there who thinks that they must trade all the time, which is not really the case. We only trade when you see a perfect opening or a perfect opportunity in the market, which sets you above standards, making you being able to make good profits from your trade entries and your trade exits. All right, next page. Now, a trading range is a horizontal corridor that contains price fluctuations for an extended period because, generally speaking, markets tend to spend most of their time in trading ranges. And unfortunately, trading ranges are very difficult to trade profitably. In fact, most technical traders will probably find that the best strategy they can employ for trading ranges is to minimize their participation in such markets, because a procedure that is easier said than done always applies. Although there are methodologies that can be profitable in trading ranges, we have oscillators, for example. Take, for example, chapter 6. The problem is that these same approaches are quite disastrous for trading markets. And while your trading ranges are especially easily identifiable for the past, they are nearly impossible to predict, because it should be noted that the most chart patterns, for example, the gaps, the flags, etc., are relatively meaningless if they occur within a trading range. Okay, within a trading range. Next page, please. Now, furthermore, it should be emphasized that fading minor trends within a trading range can actually lead to disaster unless losses are quite limited. But then we have a liquidation of position if prices penetrate range boundary by a specified minimum amount, or the market trades beyond the range for a minimum number of days, or for both. We have trading ranges that can often last for years. Figurative points that shows a 4-year trading range in an individual stock, while we have figure 4.2, which depicts part of a multi-year trading range in the Dow Jones Industrial Average that preceded the bull market, of course, in the 1980s and the 1990s. So it's more like the shorter set of lines in figure 4.2 will highlight an even tighter trading range that followed the 1974 stock market low, right? But then we have figures about 4.3, 4.4, which show multi-year trading ranges in the lumber market. And we should know that in these latter two illustrations, that trading range periods will differ in nearest and continuous futures charts, although there will typically be some significant overlap along the line, which is going to actually set us above and apart everything that we want. Okay, next page. Now, we have a breakout from trading range. For example, you have figures 4.5, figures 4.6 that suggest that an impending price move in the direction of the breakout will be the significance and reliability of a breakout are often enhanced by the following factors. Factor number one, be it a multi-year trading range. For example, Sun Microsystems and the chart was created with TradeStation by the Omega Research. So it's very important that we have all these things come in handy and know how it actually works and how to make more money from all of this. Next page, please. Next page, please. Here is a chart of multi-year range Dow Jones Industrials, and we've seen a series of uptrend, buy lows. We had two supports at the edge, close to 1,550, I'm presuming, and then we have a resistance at 2,700 thereabout, 3,000 and 3,500. Then we have trading ranges at a very important resistance zone, and we had it gradually pushing to the top so fast to make sure we have a series and series of lumber nearest futures to ideally support what we are trying to replicate on this trend, right? Next page. Next page. All right. Now we have support and resistance. Once a trading range is established, at least, let's say, for example, 1 to 2 months of sideways price movement, prices will always tend to meet resistance at the upper end of the range and support at the lower end of the range. So more like after prices break out from a trading range, the interpretation of support and resistances is turned on its head, because specifically once let's say prices witness a very important sustained breakout above a trading range, the upper boundary of that range will become a zone of price support. But the extended lines in figures 4.11 and 4.12 indicate that the support levels implied by the upper boundaries of the prior trading ranges. But in the case of a sustained breakout below a trading range, the lower boundary of that range becomes a zone of price resistance. And 4.13 and 4.14 indicate the resistance levels implied by the lower boundaries of preceding Next page. Now, prior major highs and lows, normally resistance will be encountered in the vicinity of previous major highs and support in the vicinity of major lows. But then we have figures 4.15, 4.16, and 4.17, of course. Each will illustrate both the behavioral patterns. For example, in figure 4.15, we know that the major 1988 peak formed just below the 1985 high, while the 1989 low provided a very important support level that held both the 1991 and the 1992 lows. Next page. So support near top of prior trading range, chart created with TradeStation by Omega Research. We can see important support zones and resistance zones marked out. And then there was a very important trading range right there. Trading ranges often come in a zigzag manner, up, down. And how to trade them, you buy when there is a sell market and you sell when there is a buy market. So that's just how it works. Secondly, this chart I see here with the support near top of prior trading range for December 1993 soybean oil, there were a series of ranges, and the support at the top of the prior trading range escalated to the top, and then we traced a little bit downward. But we picked out the very important part, which is the top resistance and the lower bottom at the support. And then if you are a trader expecting a flip fall, it actually didn't happen. So it's ideal that you always mark out your important support and resistance zones when trading ranges. Look for a buy market when there is a sell, as well as look for a sell market when there is a buy. Next page. The same thing we are talking about here. In figure 4.16, the late 1993 low held just below the 1986 bottom, while the 1992 reversal formed just above the early 1989 peak. And although the concept of resistance near prior peaks and support near prior lows is perhaps most important for weekly charts, and the principle also implies to daily charts such as figure 4.17, and in this latter chart, note that the May 1994 and December 1994 price reversals occurred just above the January 1994 peak, while the October 1994 low formed just slightly above the July 1994 low. And this is just how better it can get. Okay, next page. It should be emphasized that a prior high does not imply and will never imply that you should trade across subsequent rallies which will fail at or below that point, but rather than that resistances can always turn out to be important support zones at a later date, right? And that support can be anticipated in the general vicinity of that point. So some technical analysis will always try to presume the market in some very funny way, which is not what it's supposed to be. But then we have some technical analysis that treat prior highs and lows as points endowed with sacrosanct significance. And if a prior high for the stock was like, let's say 65, then they consider 65 to be the major resistance. But if, for example, the market rallies to like about 66, they consider the resistance to be broken, of course, and this will actually tell on the trade if it's a long-term trade. But this is, of course, nonsense because support and resistance should be considered approximate areas, not precise points. And we should know that although prior major highs and lows proved highly significant as resistance and support in all three charts, figures 4.15, 4.16, and 4.17, only in the figure 4.15, the subsequent price rallies and breaks actually reverse at or before reaching this point, and the price type of price action represented by the chart is fairly typical. Okay, next page. So it should be emphasized that the penetration of a previous high can be viewed as a buy signal, and the penetration of a prior low can be viewed as next page, previous page, sorry. Yes, penetrations of highs and lows should be significant in terms of price magnitude, time duration, or both to be viewed as trading signals. For example, as should be clear, let's say below, following the preceding discussion, we have regarding figures of 4.16, we have 4.17, we have a 1 period, 1 day for daily chart, 1 week for weekly chart, modest penetration of a prior high or low as the case may be. So with all that being said and done, it would not prove anything actually because a stronger confirmation that a mere penetration of a prior high or low should be required before assuming such an event which represents a buy or a sell signal. So some examples of possible confirmation conditions include a minimum number of closes beyond the prior high or low, a minimum percent price penetration, or both requirements. All right, next page, please. Now we have penetration of previous high as buy signals. We have on this chart, we've seen resistance at the prior high point. We have buy signals and support at the prior low point. Always remember, learn to mark this out because they are very ideal when it comes to treating your trades with serious priority. Okay, next page. Now, figures 4.18 and 4.19 illustrate penetrations of previous highs as buy signals, assuming a confirmation condition of 3 closes above the high. Similarly, figures 4.20 and 4.21 provide examples of penetrations of previous lows. Because as a sell market may be in check, we have offers a classic example of previous highs representing major resistances following a sustained penetration of a prior high or low, and the area of a prior high becomes support, and the area of a previous low becomes resistance. And for example, we have in figure 4.22, which reproduces about figure 4.1 and the February 1991 high, which was penetrated in July 1992, successfully holds as a support area at the September 1992 low. So it's best we understand how these things work and know how to follow through with them. Okay, next page. Now, the September low, which is subsequently penetrated in October, proves to be a resistance area that stops the late November, early December rebound in figure 4.24, which reproduced figure 4.20, the 1987 low, which penetrated in 1989 and proved to be a potent resistance area that stems repeated rally attempts in 1990 and 1991. But incidentally, we have notes that this chart also provided an excellent example of resistance at the prior high, with the major of 1994 rallies falling only moderately below the early 1986 peak. But finally, in the next figure, figure 4.2, we saw that it reproduced figure 4.21, the April 1994 low, which is penetrated in June, proves to be a major resistance area that leads to a price reversal in September. Okay, next page. So we have penetration of previous low as sell signal, coffee nearest features, and we have penetration of previous low as sell signal for soybean oil continuous features. So taking a look at this, we have resistance at prior high, up, down, sell signal goes down, pushbacks up, and then hits a very important resistance zone at the top, and then had a little retracement before we understood where the market was actually heading to. Okay, next page. Next page. Concentrations of relative high and relative lows. Now, the previous section, we dealt with important support and resistance at prior major highs and lows, single peaks, and the rest of it like that. But in this section, we will be concerned with support and resistance in price zones with concentrations of relative highs and relative lows rather than absolute tops and bottoms, because specifically there is often a tendency for relative highs and relative lows to be concentrated in relatively narrow zones. And these zones imply that support regions, if current prices are higher, and resistance areas, if current prices are lower, this approach is particularly used charts. So figure of support being encountered at a prior concentration of relative lows and relative highs, and then figuratively, figure 4.26 provides a weekly chart example of relative highs and lows. So it's best that we understand this thing that we know how it actually works. Okay, next page. Next page, please. Now, the approach of using concentrations of prior relative highs and lows to define support and resistance can also be applied to our daily chart of sufficient duration. For example, previous chart, please. For example, if the current moving average value on a stock chart is 100 and the percent value is defined at 3%, the upper bound value would be 103 and the lower bound value would be 97. By selecting an appropriate percent boundary for a given moving average, an envelope band can be defined so that it encompasses most of the price activity, with the upper boundary approximately coinciding with relative highs and the lower boundary approximately coinciding with relative lows. Okay, so this is just specifically how this thing works and how we can resume it to move along with our trade. So this is what price envelope bands are all about. Okay, next page. Yeah. So we talk about resistance zones defined by concentration of prior relative highs and lows. And next page. Bollinger Bands are well-known version of price enveloping bands. They simply add and subtract a standard deviation calculation instead of a percentage calculation from a moving average. Okay, next page. Next page. Next page. It should be noted, however, okay, chart patterns. Now, when people think of technical analysis, they often first think of well-known visual chart patterns like the head and shoulders, which is momentarily one important section. Triangles, pennants, gaps, and so on. But such patterns, whether they consist of one bar or several dozen, suggest different kinds of price behavior depending on their specific market context. This chapter will discuss not only the structure of chart patterns, but also the factors that impact their interpretation and application to these chart patterns. Okay, next page. Duration of the trading range. The longer the duration of a trading range, the more potentially significant the eventual breakout. This point is illustrated using a weekly chart example. And two, we have narrowness of range. Breakouts from narrow ranges tend to provide particularly reliable trade signals. And furthermore, such trades can be especially attractive because the meaningful stop point implies a relatively low dollar risk. And three, we have confirmation of breakout. It is rather common for prices to break out from a trading range by only a small amount or for only a few days and then fall back into the range. But one reason for this is that stop orders are frequently clustered in the region beyond the trading range. And consequently, we have a move slightly beyond the range, which can sometimes trigger a string of stops. And once this initial flurry of orders is filled, the breakout will fail unless there are solid fundamental reasons and underlying buying or overhead selling in the case of a downside breakout, which is obviously going to sustain the trend. Okay, next page. So in view of these behavioral considerations, the reliability of breakout from a trading range as a signal for any impending trend is significantly improved if prices are still beyond the range. After a number of days, other types of confirmation can also be used. Minimum percent penetration, given number of trust days, and so on and so forth. But although waiting for a confirmation following breakouts will lead to worse fills on some value signals, it will help avoid many false signals. The net balance of this trade-off will depend on the confirmation condition used and must be evaluated by the individual trader. The key point, however, is that the trader should experiment with different confirmation conditions rather than blindly follow all breakouts. This advice is perhaps even more valid than a decade ago because as increased value of technical analysis seems to have resulted in an increased frequency of false breakouts. Next page. That's all for today on our learning experience on chart patterns and the trading ranges, support and resistance. I hope we're able to understand and pick out valuable points to add to our trading style, our trading strategies, and hopefully we can secure more profits before the close of the weekend. And for BTC traders, Zito offers trading on Bitcoin, cryptocurrencies 24/7 on our platform. So never seize the opportunity. The 500 times leverage campaign is still on, and we assure everybody to take part in it and make as much money as possible from the financial market. All right. So cheers, enjoy your weekend, and see you again next week Friday for chapter 4.